Today, let's talk about the economic impact of Trump's so-called reciprocal tariffs. Over time, things have become a bit clearer, and it's worth revisiting the real motives and consequences behind these policies. First, we need to understand that the term reciprocal tariffs is more of a rhetorical tool than an actual economic concept. According to reports, when the Trump administration first announced the tariffs, the decision was made just hours earlier, based on a simple spreadsheet. Out of all the economic indicators they could have considered, they focused on just two: the volume of imports to the US and the trade balance. Using those two variables, they built a basic model in Excel and came up with what they called reciprocal tariffs. But in reality, these tariffs were never about true reciprocity. They were designed to be an aggressive bargaining chip. Trump's goal was to demand high concessions from other countries, using tariffs as leverage. But here's the catch. Once these tariffs were announced, the markets, both in the US and globally, immediately anticipated a slowdown. The US, being one of the largest consumer markets in the world, plays a critical role in global demand. So when the US starts imposing tariffs, it doesn't just affect imports, it sends a signal that consumption might decline. People began stockpiling goods, and inflationary expectations quickly turned into reality. And when inflation rises, economic pressure builds. If the US economy shows signs of slowing, that sends shockwaves through the global economy, especially for major exporters like China. Naturally, oil prices started to drop, reflecting concerns about future demand. Now, in terms of inflation, there are two key drivers: monetary policy and energy prices. When oil prices fall, inflation pressure eases. In this sense, Trump's tariff policies unintentionally helped Federal Reserve Chairman Jerome Powell by easing inflation, at least in the short term. Lower inflation gave the Fed more room to consider rate cuts. Recent U.S. job reports reflect this tension. In March, the U.S. added 228,000 new jobs, while the unemployment rate inched up slightly to 4.2%. This set the stage for Trump to publicly urge Powell to cut interest rates, claiming that lower oil prices and controlled inflation created the perfect conditions for such a move. But here's the contradiction. If employment is strong, that typically signals a healthy economy. So why the rush to cut rates? Trump's real motivation, it seems, was to lower borrowing costs, not just for consumers and businesses, but also for the government and his trade strategy. By creating the expectation of an economic slowdown through tariffs, Trump triggered a flight to safety. Investors rushed into the bond market. As demand for U.S. Treasury bonds increased, bond prices rose and yields fell. This led to a natural drop in market interest rates, independent of any direct action by the Fed. And here's an interesting twist. Instead of fleeing to traditional safe havens like gold, investors chose U.S. government bonds. This shows that markets were reacting to fears of recession rather than expecting immediate monetary policy changes. It wasn't about Powell promising rate cuts, it was about economic fundamentals. From a strategic standpoint, this created another advantage for Trump. Lower yields made borrowing cheaper, just as trade negotiations were heating up. With tariffs as leverage, the U.S. could now push countries not just to buy American goods, but also to invest in U.S. debt. In other words, reciprocal tariffs could also serve as a tool to attract capital into U.S. bonds, adding another layer of economic advantage. Of course, other countries didn't stay silent. China, for instance, responded with its own countermeasures. One notable move was the 34% retaliatory tariff, a sharp and calculated reaction. Unlike previous symbolic responses, this time China opted for a clear, one-to-one counterattack. The logic behind this was strategic. There were three possible scenarios in play. First, if other countries followed China's lead, the U.S. would find itself isolated in global trade. As the world's largest exporter, with about 30% of global share, China's moves carry weight. A collective response would make Trump's tariff policy unsustainable. Second, even if other countries chose to negotiate individually with the U.S. and drop their tariffs, the pressure on China would not necessarily increase. Instead, the effectiveness of Trump's reciprocal tariffs would be diluted. If tariffs are lifted for others, but China holds firm, the whole concept of reciprocal tariffs collapses. Third, if countries negotiate and return to original tariff levels, but still depend on Chinese manufacturing, they would essentially be hurting themselves. Global supply chains are tightly linked, and countries that rely on Chinese production can't easily shift away without paying a price. So, from this perspective, China's 34% retaliatory tariff wasn't just a response, it was a well-calculated move. It forced both allies and rivals to think twice before siding with Washington. In addition to tariffs, China still holds several powerful economic cards. These include anti-monopoly rules, export controls, and customs regulations. While these haven't all been played yet, there remains strong deterrence. As for Trump's broader goal, it's clear that tariffs were never just about trade. They were a tool to shift industrial supply chains, pressure central banks, influence bond markets, and reshape global alliances. We also saw responses from other nations. Argentina backed away from imposing tariffs. Vietnam initially claimed it would remove all tariffs on U.S. goods, but later clarified that any changes would depend on the U.S. offering equal treatment. Israel eliminated tariffs, while Canada pushed towards zero tariffs too, but maintained strong resistance to the 25% auto tariff. The European Union, especially under French President Macron, promised a strong retaliatory response, warning companies against investing in the U.S. and preparing broad countermeasures. In conclusion, Trump's tariff strategy was never just about balancing trade figures. It was a multi-layered economic tactic, influencing inflation, interest rates, capital flows, and global supply chains. And while the public discourse often centers on job numbers or tariff percentages, the real game was always about leverage, timing, and pressure. For policymakers and investors alike, the lesson is clear. In today's world, economic policy is not just numbers. It's narrative, it's negotiation, and it's positioning, and tariffs are just one piece of a much bigger puzzle. Thanks for watching. If you enjoyed this video, consider liking it. If you didn't, blame the Excel file.